Okay, welcome everyone. Today we are diving into our final masterclass explainer, and we're tackling Chapter 22, Corporate Reorganizations for your BPT 2025 exams. Now, I want you to take a deep breath and get your notes ready. I'm going to be speaking quite slowly and deliberately today because, well, this is incredibly dense academic material. We really need to establish a clear, authoritative foundation step by step. Really, this chapter is the culmination of absolutely everything you've learned so far. So let's take our time and get this right. Here is our roadmap for today. We'll start by navigating corporate reorganizations in general. Then we'll look at the vendor's perspective, followed by the buyer's perspective. After that, we'll get into intra-group transfers and hive downs, management buyouts, and we'll wrap up with some crucial exam strategy. All right, part one, navigating corporate reorganizations and synthesizing the BPT syllabus. So, this chapter is essentially a giant puzzle. It brings together your knowledge of corporation tax, group relief, stamp duty land tax, VAT, and capital gains tax all into one single place. And if you take only one thing away from this entire explainer, let it be this: mastering the net cash calculation is your absolutely key exam skill. The examiner doesn't just want you to memorize rules. No, they frequently demand a full, detailed calculation of the net cash position under alternative restructuring routes, and then they want your professional recommendation based on those numbers. You literally have to prove the math. Moving on to Section 2. Let's look at the vendor's perspective, specifically the choice between selling shares versus selling the trade and assets. When a parent company decides it wants to exit a subsidiary, they face a fundamental choice. Do they sell the shares directly, or do they sell the underlying trade and assets? Now listen closely. If you choose to sell shares, you must check the Substantial Shareholding Exemption, or SSE, immediately. For this to apply, the selling company must have held at least 10% of the ordinary share capital. They must have held it for a continuous 12-month period within the 6 years prior to disposal, and the subsidiary must be a trading company or part of a trading group. If all those criteria are met, the vendor receives the full proceeds completely free of corporation tax. It is a massive, massive advantage. But let's contrast those two routes directly. A sale of shares is, generally speaking, much simpler. Your gains might be SSE exempt, the transaction is VAT exempt, and any unused losses just transfer right along with the company. But look closely at that bottom row. Under a trade and asset sale, that is handled via a transfer of business as a going concern, or TOBGC. And crucially, those hidden ghosts in the closet, the contingent liabilities, they actually remain with the vendor company. The buyer doesn't take them on. So this leaves the vendor holding all the risk while at the same time facing potential corporation tax on individual asset gains at either 19 or 25%. Okay, so here is your vital 4-step net cash calculation for a trade and asset sale. Step 1, you calculate the corporation tax on the individual asset disposal gains. Step 2, calculate the net cash remaining in the subsidiary after those liabilities and that tax are paid off. Step 3, determine exactly how that cash is distributed up to the parent. Now remember, pre-liquidation distributions are treated as exempt dividends, whereas post-liquidation distributions are treated as capital, which conveniently might qualify for our good friend the SSE. Finally, step 4, you compare this final net cash figure with the direct share sale proceeds. So we've spent some time looking at the seller, but what if you are the one writing the check? Let's pivot for a second and look at this exact same transaction from the other side of the negotiating table. That brings us to Section 3, the buyer's perspective, inheriting a company's history versus starting with a clean slate. As a buyer, you have a huge strategic decision to make. Do you inherit the target's past, or do you start completely fresh? If you purchase the shares, you inherit the historic tax written down value, or TWDV, of the assets. And yes, you inherit all of those hidden contingent liabilities we talked about. However, you do avoid SDLT, paying only a 0.5% stamp duty. On the flip side, if you purchase the trade and assets directly, you get a clean slate, no inherited ghosts. And crucially, you get a step up to a current market value-based cost for those assets, which means higher capital allowances going forward. The downside? Well, you might get hit with SDLT on the land, and you have absolutely zero access to the target company's pre-acquisition losses. Now, I want you to burn this specific figure into your memory: 6.5%. Since April 2019, buyers purchasing goodwill from an unrelated party in an asset purchase can actually claim a 6.5% annual deduction. To put that into perspective, it makes the clean slate approach of an asset purchase significantly more attractive, especially for businesses carrying a lot of goodwill.
All right, Section 4. Let's dig into intragroup transfers and hive-downs within a 75% group.
Before selling a subsidiary to a third party, large corporate groups will often restructure. Now, within the group, the transferor company can move capital assets at no gain, no loss, or NGNL. You do need to be incredibly careful with losses here, though. Trading losses will transfer, but they are strictly restricted by any net liabilities the transferor retains, and pre-April 2017 losses are completely ring-fenced. For the purchaser within the group, the good news is there's no immediate SDLT on land, but beware of the trap. A 3-year clawback applies if that purchasing company is subsequently sold outside the group.
And that naturally leads us to the hive down. Conceptually, this is brilliant. It is the perfect marriage of a share sales simplicity with an asset sales clean slate. Step 1, the vendor forms a brand new, completely clean subsidiary. Step 2, they transfer the desired assets and the trade into it using those intragroup no gain, no loss provisions we just discussed. Step 3, they sell the shares of this newly minted, squeaky clean subsidiary to the third-party buyer.
From an exam perspective, the tax implications of a hive down are highly testable. Let's walk through them. Capital assets transfer at no gain, no loss, while plant and machinery and intangible fixed assets transfer at their written down value. The transfer itself is treated as a TOBGC, which keeps it safely outside the scope of VAT. But pay close attention to bullet point 3. SDLT is charged on the land. Why? Because the immediate sale to a third party triggers that 3-year clawback rule we warned about. Finally, the SSE rules actually look through the new company. So as long as those assets were used in the group's trade for 12 months prior and the shares are sold within 12 months of the hive down, SSE applies.
Moving right along to Section 5, management buyouts. What happens when the management team becomes the actual owner?
In an MBO, the existing management team acquires ownership. Usually, they are buying a clean hive down vehicle using some of their own capital combined with some heavy external borrowing. The examiner absolutely loves testing the 3 core tax hurdles for the management team here. First, if the managers get their shares below market value, well, it's not just a good deal for them, it triggers an immediate heavy employment income charge subject to both income tax and national insurance. Second, if the shares are only partly paid up front, the unpaid amount is treated as a beneficial loan, which creates a benefit in kind. But third, on a more positive note, if it's an MBO close company, the managers can claim some vital interest relief on their personal loans.
Here is another critical rate I need you to write down right now. 2.25%. This is the official rate of interest that is applied to calculate that beneficial loan benefiting kind on any unpaid amount of partly paid MBO shares. Don't forget it.
Now, regarding that interest relief for the managers who are taking out massive personal loans to fund their equity, it is incredibly valuable, for sure, but it is strictly capped. The relief is capped at the higher of £50,000 or 25% of their adjusted total income. Make absolutely sure you apply this cap in your exam computations.
And finally, Section 6, exam strategy and key rates. Let's synthesize all of this for the exam.
Okay, my exam coach hat is officially on. You absolutely must have these critical metrics memorized perfectly before you even walk into that exam hall. Read these slowly with me. The SSE minimum holding is 10% for 12 continuous months. A degrouping charge has a strict 6-year look-back period. Stamp duty on shares is exactly 0.5%. A change in ownership places a rigid 5-year block on surrendering post-April 2017 carry-forward losses. And lastly, in an intragroup transfer, the loss transfer is restricted by the transferor's retained net liabilities.
Here is your final checklist straight from the examiner's perspective. Please, do not just describe the rules in a big paragraph. Always calculate and explicitly compare the net cash positions. Check the SSE conditions first before you do any other math on a share sale. Always flag the SDLT clawback on land in a hive down. It is a classic trap that so many students miss. And be sure to identify all 3 of those management tax issues in an MBO scenario. Remember, the examiner wants to see the math.
Before I wrap up this explainer, I'm going to leave you with a bit of a puzzle to test your comprehension. If buying assets gives a buyer a clean slate and a step up to a market value-based cost, why on earth might a buyer still strategically choose a share purchase, fully knowing they will inherit all the target's hidden contingent liabilities? Think carefully about the simplicity of the transaction. Think about avoiding SDLT. And perhaps most importantly, think about the access to those pre-acquisition losses. Ponder that as you review your notes tonight. Thank you so much for joining this Masterclass Explainer, and best of luck in your BPT exam. You've got this.